Well, the theme for the Money Show for this year is diversification. It's important that you put your money in a portfolio that comprises more than just equities. So keeping it with that theme, last Friday we spoke to Vested Finance on inclusion of outside Indian assets. It may be in the form of stocks or funds. Here's a small conversation that we had with Viram Shah of Vested Finance. In 2020, if we talk about what really has been the theme that played out, it's got to be risk-taking. If you had invested in risky assets at the height of the pandemic in March, like Bitcoin, like equities, they've actually managed to give you way better returns than the relatively safer assets like gold. And yes, I say that even though gold hit record highs during the year, but it's the Nifty, the Sensex, the Bitcoin as well. If you had just invested in these benchmarks, it would have surpassed the return through and through. So perhaps for the year 2020, it was all about risk taking. But what will be the theme for the year 2021? It looks a little unlikely that equities will continue their stellar run up from our conversations with market participants. But the one thing that will work to conserve, to create and multiply wealth is diversification, and that's going to be the Money Show's theme for 2021. How can you diversify investments? Looking at options beyond just equities. These are some of the topics that we will explore over the course of the next few weeks on the Money Show. So on today's topic of diversification, we are going to introduce foreign investing. What are the ways to invest in foreign stocks, foreign markets, foreign bonds, and what have you? Is it safe for you to invest? How much should you invest? What are the risk factors is all that we will be discussing. Remember that to invest in foreign markets, thanks to, of course, the advent of fintech, thanks to, of course, a variety of other innovations brought forward, the borders around investment have come down. Most of us, in fact, don't have any foreign assets in our portfolio. So you not only are missing out on perhaps, return opportunities in these foreign assets, but there's no geographical diversification in your portfolio. Where and how do you invest? Well, you can of course invest directly in stocks, but if you believe that you don't have the know-how to do so, there are feeder funds and mutual funds. Motilal Oswal, Kotak has recently launched one, Franklin Feeder Fund. There are several mutual fund houses that have foreign stocks in their portfolio or are essentially oriented around foreign stocks. There are country-specific ETFs as well, Nasdaq ETF, Russia ETF, and what have you. And then of course we have some funds with a good 25% of their holdings in foreign stocks. I think one of the most popular examples, and we've brought on board this fund in our Meet Your Fund Manager segment as well, is the Parag Parikh long-term fund.
Basically, you shouldn't be having all your money held in one currency or held in one market. You should have some part of your portfolio diversified in other markets, and that is what geographic diversification is all about. And now, because of technology, it's become much easier to also invest into funds that are in India, investing internationally, but also directly investing. So you can actually open up a brokerage account outside of the country in the US and start investing internationally. So say somebody wants to invest directly in the international markets by opening up a brokerage account. You can invest as an Indian resident. Every year, you're allowed to transfer up to $2.5 lakhs. So that's $250,000 under the RBI's liberalized remittance scheme. So basically, what this scheme governs is what is called a remittance, which is how much money you can move outside of the country. And so under this scheme, there are different purposes that they have allowed. So there is education, there is travel. One of these purposes is also a portfolio investment abroad. So legally, you can do up to $2.5 lakh per individual. If a family is looking at it, we see people allocate about up to $1 million for a family of 4 to invest internationally.
All right. Well, let's take forward this conversation on investing in foreign assets. We have with us Chintan Haria, who is the head of products and strategy of ICICI Prudential. The fund that we are going to discuss with him excuse me, is the ICICI Prudential Global Advantage Fund. It's a fund of fund. What exactly does that mean? And how essentially this product will help you diversify. Chintan, thank you so much for joining us today on ET Now. It's a pleasure having you with us. So to start with, Chintan, I'm sure you'll agree with everything that essentially Mr. Viram Shah as well has mentioned about why it's important to diversify your portfolio and include foreign assets and foreign funds. So could you tell us that what exactly does the ICICI Global Advantage Fund do? How does it invest? Where does it invest?
Sure. So good evening, Mubina, and thank you for having me on the show. Wishing all your viewers a great 2021. I think we couldn't have had a better start to 2021 with three-pronged good news. Of course, yesterday, whatever happened in the test match, I think that's moved the nation. The markets at a high, and of course, the vaccination, which I think we were looking at the ads going on in full swing. So great start to the year, and I wish this continues for the rest of the year and beyond. On the topic of discussion on diversification, of course, I would like to say that we as a fund house have always believed in diversification, and that's where asset allocation has been a key theme. And within that, dynamic asset allocation funds is something which we've always been asking investors to have as a core part of their portfolio. Apart from dynamic asset allocation, again, a part of diversification within the equities, we believe macro investing and special situation investing is something which should be looked at. Of course, on the topic of foreign investing, which is what the core topic for today's discussion is, we again, way back in 2012, had launched a US-focused fund which was investing abroad. The key reason and element for that, so just to one step back, why is it important for investors to invest abroad, and why is it a key part of the portfolio? We've seen, over the past many years, the global market capitalization today is $100 trillion. India is about $3 trillion. So there's a huge market potential which is waiting outside for investors to invest in. Apart from all the digital mediums and what was mentioned earlier about the liberalized scheme, it is not always possible for investors to invest directly abroad. There are expenses on remittances, etc., which can probably eat away your return. So the easier way or the better way to invest, we believed, was to invest in India funds or India mutual funds which are investing abroad. And that's where we launched the US Blue Chip Fund. Along with, that was in 2012, because we had a view that US may do well between 2012 and beyond, and rupee will depreciate. So one of the core reasons we've seen investors wanting to diversify into international funds is, of course, many of them want their children to study abroad. And with INR generally depreciating, investing in international assets proved to be a good hedge against the INR depreciation, as well as having dollar assets, which help to fund the foreign studies for their kids. Also, the fact that India is one part of the global market, like I said, and within that, we felt that as an offering, the ICICI Prudential Global Advantage Fund, which is a fund of fund investing across all the possible options that are there in India, the funds which are investing abroad is a great way for investors to be invested in foreign securities. So that's where the thought came in, and somewhere around September 2019, the fund was launched. The fund is a very simple fund in terms of its thought process. We strongly believe that there are cycles. VCTS framework is very famous, wherein we look at valuation cycles, triggers, and sentiments. And basis on that, we basically select which country the money should go in within the options which are available. So currently, if you look at the fund, which is a debt taxation fund because of the fact that it is a fund investing in global equities, or funds investing in global equities, today the allocation is almost equal between emerging markets and developed markets. But the key over here is that investors obviously will not have the exact know-how. Should they invest in Brazil today? Should they invest in China? Should they invest? You mentioned about Russia. You mentioned about, even countries like Australia or US. The key thing over here we should remember is over the last 5 years, if I have to see, 2015 calendar year, China was one of the better performers. 2016, it was Brazil. 2017, it was India, of course. All of you would remember we were roaring in 2017. 2018-19, it has been pretty much US, which has done well, especially in 2019. So each year, the country which does well keeps changing. Can investors keep a track of it? I mean, you and I, will we have time to understand which cycle is working in which particular country? And that's where the Global Advantage Fund of Fund comes in handy, because essentially the fund management team is selecting which country you should be investing in. And today, like I said, it is almost equal between developed markets and emerging markets. So we have a US allocation, we have an Asia allocation, we have a Hang Seng allocation, and we have even a Japan allocation, because we believe with dollar depreciating, it will probably help the Asian countries and Japan among the developed markets. So we do allocate between various options. And the good part from an investor perspective is that they do not need to worry about, changing the allocation, taking out money. There are exit load implications. There are taxation implications. All of that are nullified from an investor perspective. You basically have a core 5, 10, 15% allocation to international equities through the Global Advantage Fund of Fund. And the fund managers will probably keep rotating between which they feel are the best countries or the better countries to invest in looking forward, basis whatever information they have on the cycles that the country is going through.
Okay, I think you've largely covered many points in this answer. Chintan, I want to talk about two things. One is cost and the other is risk. It's a fund of fund. So, what would you have to comment on the cost bit? Is the administration cost sometimes a little higher? And this risk factor compared to, would you recommend that people who have a very conservative approach should perhaps not invest in a fund like this and would be perhaps better off investing in a large cap or an index fund?
Yeah, so effectively, there are two parts to the question. First is which kind of investor should invest, and second is the expense ratio. The expense ratio pretty much is within the regulatory ambit, so that's not an issue at all. There is no extra expense ratio as such beyond what is allowed regulatory-wise. And like I said, from an investor perspective, if you are getting a fund management team to change the allocations and be in the right country, you probably will find that in the longer run, the returns more than make up for the expense ratio part, if at all the expense ratio becomes a question for a fund of fund. Again, it's important from a risk perspective. You mentioned, is a single country risk more than a diversified bouquet of countries? Normally, a single country risk can be high. You can make great returns as well as you potentially can see a cyclical downturn. For example, whenever commodities boom, countries like Brazil, Australia, Indonesia, they may end up doing well, even China for that matter, both in terms of their currency appreciating and their equities doing well, which again helps the investors in those countries in a big way. And the reverse is also true. So whenever the cyclical lows happen, we find these countries doing badly. So it becomes important to select the right countries at the right time. And I think that's where the cost benefit works in favor of investors being in a global advantage fund of fund kind of a fund, which is moving between developed markets and developing markets, and within developing markets, the resource-rich countries and the non-resource countries, in a manner where you basically paying heed to what are the flows, where are the flows going into. If a countries or if emerging markets are seeing huge flows, much the same way as they are seeing in the last 12 months, and they become overheated, you may want to go out of emerging markets, which are very, very frenzied or higher on valuation, and may want to move out. An individual investor may not be able to keep a track of all these things. So it's not for a conservative or an aggressive investor. It is essentially for an investor whose overall asset allocation allows international investing. And once you've decided that I want to probably have an international allocation, this becomes a good tool in the hands of the investor to have a diversified fund which invests across many countries and different proportions. And the proportions, like I said, are based on certain sound logic, which is based again on our principle of valuation cycle, triggers, and sentiment, wherein if there are significant flows in a particular country and the country becomes overvalued, we'll take out money from there. So it's about looking ahead. It's about allocating in the right manner. And that's why I would say that even for a conservative investor or a risk-taking investor, the percentage of allocation would change. But the type or the mode of allocation should be the global advantage fund of fund kind of a fund, because it gives you a multi-country approach, as well as you don't need to keep changing between one country and another and keep paying taxes, etc., because it obviously has leakages of taxes and exit loads, etc.
Chintan, thank you so much for joining us today on the show, with all your views on, investing in foreign funds. Well, on that note, we'll take a very quick break on the show. Don't go anywhere.